Many young people across Europe are currently obsessed with the concept of financial autonomy, constantly seeking hidden leverage points to escape the standard economic grind. If you commit to understanding the hidden mechanics revealed in this narrative, you will unlock a level of economic literacy that guards your wealth and permanently separates you from the misinformed masses. Think of the modern financial system not as an open, free market, but as a vast, invisible net that silently harvests the capital of the uninitiated to enrich the few at the very top. On Friday, June 12, 2026, a massive net was cast, and your capital was likely caught in it without your conscious consent. At exactly 9:50 a.m. Eastern Time on that Friday morning, an automated transaction took place across millions of accounts globally. You were not asked for permission, no documents required your signature, and no confirmation email arrived to alert your inbox. Yet, if you hold any standard retirement vehicle or a broad market index fund, a significant order was instantly routed on your behalf. The purchase price for this unrequested asset was determined by a calculated regulatory shift, enacted merely months before this historic public offering, specifically designed to make this automated trade happen. The underlying mechanics trace back to recent alterations in the inclusion criteria for major financial benchmarks. In the months leading up to the public listing, the operators of the Nasdaq 100 and the Russell 1000 fundamentally rewrote their traditional playbooks. The updated framework permits unprecedentedly large initial public offerings to be integrated into major indexes in as little as 15 trading days. By eliminating the historical free float restrictions that usually protect everyday investors, the doors were flung wide open the exact moment trading commenced. We are now observing the immediate aftermath of this systemic realignment. By early July, an estimated $7 billion to $27 billion of mandatory institutional buying will flood into this specific asset. This massive wave of forced demand will collide with a highly restricted circulating supply of only $89 billion in actual tradable shares. Consequently, the price your automated account pays will not reflect the intrinsic value of the enterprise, but rather the artificial price ceiling created when mechanical buying collides with a tiny sliver of float. This represents the single most expensive inadvertent transaction the average observer will execute in the year 2026. While active participants debated the merits of the listing, a completely different apparatus made the decision for the passive majority. If your portfolio contains a standard index tracking product or a default target date fund, you are directly involved. The aggressive speculator is not the most vulnerable actor in this arrangement, but rather the quiet investor who assumed safety in non-action. To understand the gravity of the situation, one must analyze the stark structural architecture of the listing. The asset debuted at $135 per share, rapidly ascending to an intraday high of $176.52, before settling at $160.95. This brought the aggregate valuation to approximately $2.1 trillion, instantly placing it among the largest corporate entities in existence. However, the public offering only released a mere 4% of the total corporate shares into the open market. The remaining 96% of the equity remains strictly locked in the hands of corporate founders, early employees, and select venture institutions. This means a microscopic pool of available shares is currently supporting a massive megacap valuation. This severe imbalance is not an accidental market anomaly, but a deliberate environment that the rewritten index rules were specifically designed to facilitate. Under the legacy framework, a newly listed corporation was required to wait at least 3 months to allow for natural price discovery. The historical 3-month buffer existed to protect public capital from artificial volatility and to let the market digest the new supply naturally. The revised methodology completely dissolved this protection, compressing 90 days into a mere 15 trading days for top-tier capitalizations. Major exchanges compete fiercely for high-profile listings because they bring immense prestige and transaction fees. The rapid inclusion rule functioned essentially as an institutional incentive to secure this specific multi-trillion-dollar entity. Counting from the initial listing date, the mandatory eligibility window officially opens on Thursday, July 2nd. The index committees typically finalize the effective integration on the following Monday, which lands on July 6th. This condenses the entire journey from public debut to mandatory index inclusion into a brief span of 24 calendar days. Simultaneously, parallel fast-track methodologies were adopted across multiple index families, ensuring a synchronized influx of forced capital from different market sectors. An even deeper layer of this structural shift involves the complete elimination of the minimum free float requirement for fast-track entries. Historically, an index required a substantial percentage of a company's shares to be publicly tradable before assigning it a full market weight. This rule prevented index funds from causing massive price distortions by chasing a tiny sliver of available stock. By deleting this safeguard weeks before the debut, the systemic guardrails were removed, leaving public retirement accounts entirely exposed to the microfloat bottleneck. The absolute scale of the capital involved reveals the true magnitude of the impending mechanical squeeze. Over $527 billion currently resides within exchange-traded funds that replicate the Nasdaq 100 alone. When extending the calculation to include broader institutional vehicles, futures, and benchmarked products, the total tracking capital approaches $1.4 trillion. A 0.5% allocation across these platforms translates directly into billions of dollars of mandatory, non-negotiable buying. Active managers chasing the benchmark must absorb these shares or accept tracking error, which directly impacts their performance metrics. Analyst estimates indicate that funds tracking these major benchmarks will need to absorb roughly 24% of the public float. When factoring in benchmarked active managers, the total absorption easily exceeds half of all publicly available shares. This is not a reflection of market sentiment or analyst conviction, it is the rigid execution of an automated rule. The true brilliance of this design becomes apparent when juxtaposed with the corporate insider unlock schedule. The forced institutional buying wave peaks in early July, driving artificial demand against a highly restricted public float. Weeks later, beginning on August 21st, the first massive tranches of insider shares are unlocked and become eligible for liquidation. Additional supply gates will open sequentially over the subsequent 90 days, introducing massive waves of secondary corporate selling. This precise sequence establishes a highly predictable directional flow for the asset's price. The passive index fund is forced to buy near the apex of the mechanical demand wave, while the corporate insider liquidates positions directly into that artificial liquidity. This represents a flawless, legal mechanism for transferring massive wealth from passive retirement accounts to concentrated insiders. The entire architecture operates perfectly within the rules, yet remains completely invisible to the individuals funding the trade. This financial playbook is not entirely unprecedented, having been executed on a smaller scale during the winter of 2020. When a major electric vehicle pioneer was added to the standard benchmark, its equity surged approximately 40% between the announcement and the final inclusion. Institutional funds were forced to absorb tens of billions of dollars in shares at highly inflated prices to maintain benchmark synchronization. In the subsequent months, the asset significantly underperformed as artificial demand dissolved and reality reasserted itself. The rules governing your modern portfolio are continuously authored by architects who never require your explicit vote or permission. Recognizing these hidden mechanisms is the most critical asset an investor can cultivate in an era dominated by automated indexing. For those navigating the contemporary economic landscape, the ultimate advantage is not merely acquiring data, but possessing the cold willingness to analyze the structural rules before the headlines dictate your choices. True financial autonomy begins when you refuse to let invisible algorithms decide the price of your future.